Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host at AlgoBot, and today we're exploring an expert advisor called Pivot Zone Rejection Hedge. This is a pure price action approach. It uses no traditional indicators at all. Instead, it leans on classic floor pivot levels, support and resistance rejection, candle patterns, and a managed hedge. By the end of this video, you'll understand how it reads the market, how it enters and exits, and how its signature hedging mechanic works. Remember, this is educational content only and not financial advice. Let's get started. So what exactly does the Pivot Zone Rejection Hedge expert advisor do? At its heart, it's a pure price action system. There are no moving averages, no relative strength index, no average true range, and no Bollinger Bands anywhere in its logic. Instead, it builds everything from raw price and from classic floor pivot levels. Every time a new bar closes, the strategy looks back over a set number of completed bars, 24 by default, and finds the highest high, the lowest low, and the most recent close. From those three numbers, it calculates the central pivot, a first resistance level above it, and a first support level below it. These are the same reference levels that countless intraday desks watch every day, which is exactly why price tends to react around them. The approach trades both directions. When price dips into the support zone and then snaps back above it with a strong rejection candle, the strategy reads that as sellers being turned away and it looks to buy. When price pokes into the resistance zone and then closes back below it with a bearish rejection candle, it reads that as buyers being turned away and it looks to sell. The signature feature is the managed hedge. If a level fails instead of holding, the strategy stops fighting the move and opens an opposite leg to ride the breakout the other way. The locked pair is then closed together using basket money management, once the combined floating result reaches a chosen target. This style is generally framed for liquid, range-respecting markets. Think major foreign exchange pairs like Euro versus US dollar or Australian dollar versus US dollar, or gold against the US dollar, on the 15-minute, 30-minute, or 1-hour time frames. It's aimed at traders curious about structured, rules-based price action. As always, this is for educational purposes only, and trading always involves risk, including the risk of loss. Let's walk through the mechanics step by step. Everything begins with the floor pivots. On each freshly closed bar, the strategy recalculates the highest high and lowest low over its look-back window, takes the latest close, and derives the central pivot, the first resistance level, and the first support level. The distance between resistance and support becomes the strategy's natural measuring stick, so every buffer and target scales automatically to any symbol or time frame. For a long setup, three conditions must all be met. First, the just closed candle must dip into the support zone, meaning its low reaches at or below the support level plus a small tolerance. Second, that same candle must close back above support, showing the level held. Third, the candle must be a genuine bullish rejection. Its lower wick has to dominate its body by a chosen ratio. The lower wick must be larger than the upper wick, and the close must finish in the upper half of the candle's range. When all three line up, the strategy opens a buy. The short setup is a mirror image. The candle pokes into the resistance zone, closes back below resistance, and shows a bearish rejection with a dominant upper wick and a weak close in the lower half. When that aligns, the strategy opens a sell. For each base trade, the take profit aims at the central pivot, capturing the mean reversion move back toward the middle. The stop loss is placed a structural pad beyond the hedge point, so the hedge always engages first. That hedge is the next piece. While a base trade is open, if price travels a set fraction of the range beyond the rejected level, the strategy concludes the level has failed and opens an opposite market leg. Now both directions are held, a locked hedge designed to ride the breakout and offset the losing base leg. Finally, basket money management governs the exit while any exposure is held. If the combined floating profit reaches the basket target, everything closes together. If the combined floating loss reaches the basket limit, the strategy flattens completely, capping risk. This is educational information only, and not a recommendation. Let's look at the actual MetaTrader 5 code on screen. At the top are the input parameters you can adjust. PivotLookback sets how many closed bars define the pivots. ZoneFrac controls how close to a level the wick must reach. WickBodyRatio defines how dominant the rejection wick must be. HedgeFrac sets how far beyond a level price must travel before the hedge engages. And BasketTpMoney and BasketSlMoney define the profit target and the loss limit for the whole basket, while lots sets the order size. Now the long block. The Boolean touched S checks that the candle's low dipped into the support zone. Closed above S confirms the candle closed back above support. And bull ray confirms the rejection shape. The lower wick is at least the wick-to-body ratio times the body. The lower wick exceeds the upper wick, and the close sits in the upper half. When all three are true, the code calls trade.buy, with the stop loss placed beyond the hedge point and the take profit set to the central pivot. The short block mirrors it exactly. Touched R checks the high poked into the resistance zone. Close below R confirms the close came back below resistance. And bear ray confirms the bearish shape with a dominant upper wick and a weak close. When those align, the code calls trade.sell, again with the stop loss beyond the hedge point and the take profit at the central pivot. Notice both sides are true mirror images of each other. This walkthrough is for educational purposes only. Now let's bring it all together on the chart. You can see three dashed horizontal lines. The red line near 1.0890 is the first resistance level. The gray line near 1.0860 is the central pivot, and the green line near 1.0830 is the first support level. These are the floor pivots the strategy calculated from recent bars. Watch the opening candles on the left. Price is drifting lower, candle after candle, sliding down from above the central pivot and heading toward support. By the second and third candles, the market is pressing right into the green support zone. This is the moment the strategy is waiting for. Not a clean break, but a test. Look closely at the rejection candle as it reaches support. Its lower wick stabs below the green line, down near 1.0826, but then buyers step in and push the close back up above support, finishing in the upper half of the candle. That long lower wick with a strong close is exactly the bullish rejection the strategy is screening for. Sellers tried to drive price lower, and they were turned away at support. With all three conditions satisfied, the dip into the zone, the close back above support, and the dominant lower wick, the strategy opens its buy, marked here as the buy entry around 1.0841. The take profit is set toward the central pivot. Over the next couple of candles, price lifts steadily off support and climbs back toward the middle. As it reaches the gray central pivot near 1.0860, the long trade reaches its take profit. That's the mean reversion idea in action. Fade the rejection at the edge and aim for the center. Now the market keeps rising past the pivot. Notice how price continues upward, candle by candle, until it approaches the red resistance line near 1.0890. This sets up the mirror image short. Watch the rejection candle at resistance. Its upper wick pierces above the red line, up near 1.0896, but then sellers take over and force the close back below resistance, finishing in the lower half of the candle. That dominant upper wick with a weak close is the bearish rejection the strategy needs. Buyers pushed into resistance and were turned away. With the poke into the zone, the close back below resistance, and the upper wick dominating, the strategy opens its sell, marked as the sell entry around 1.0882. Again, the take profit aims back toward the central pivot. Over the following candles, price rolls over and slides down from resistance. And as it returns to the gray pivot near 1.0860, the short trade reaches its take profit. So across this single illustration, you've seen both halves of the strategy working symmetrically. At support, a rejection from below set up a long back toward the pivot. At resistance, a rejection from above set up a short back toward the pivot. And remember, in live conditions, a level can fail rather than hold. And that's precisely when the hedge leg would engage to ride the breakout the other way. This is an illustrative example for educational purposes only, and real markets will not always behave this cleanly. That brings us to the end of our look at the Pivot Zone Rejection Hedge Expert Advisor for MetaTrader 5. We covered how it builds floor pivots from recent price, how it enters on bullish rejections at support and bearish rejections at resistance, how its take profit aims back toward the central pivot, and how the managed hedge and basket money management handle a level that fails. Everything here is educational content only and not financial advice, not a recommendation, and not a solicitation to trade. Trading carries real risk, and losses do happen. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more MetaTrader 5 strategy walkthroughs. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.